After the BCVL entries, the next part would be intra-group transaction. With intra-group transactions, as you all know, there are a number of categories of them, and you should actively look for them in the original question. The reason that you need to actively look for them, that's because not every single one of these intra-group transactions will be provided under additional information. I'll give you a very simple example. If you think about dividend, pretty much every single question will talk about dividend. But when you scan through all this additional information, you will see that there's no information about dividend at all, because they don't need to give you any additional information. All you need to do is to go to the financial statement and look underneath the subsidiary, only the subsidiary, because only the subsidiary dividend is an intra-group transaction. So if you take a look here, you will see that we have two amounts of dividend, $5,000 of interim dividend paid, and also $18,000 of final dividend declared. So both of them will become part of the intra-group transaction. The other thing about dividend is that this is the only intra-group transaction where you need to multiply by the parent's percentage of ownership, because the amount of dividend will follow ownership. So with the intra-group transaction, we need two journals for dividend. First of all, we want to debit dividend revenue, and then credit dividend pay, and this one is about the interim dividend. The amount was $5,000. Remember, this one we need to multiply by the percentage of parent ownership, 70%. That will be $3,500. After that, we also got dividend declared as well. So again, we are going to debit dividend revenue and credit dividend declared. The amount was $18,000. Once again, we need to multiply by the percentage of ownership, so the amount will be $12,600. And because this one is dividend declared on top of the revenue, you also need to eliminate the payable and receivable as well. So we're going to debit dividend payable. Same amount as before, and then credit dividend receivable. $12,600. So that will be the first intra-group transactions. After that, I tend to follow the order of the additional information provided. So going back to the original question, so you can see that we got a number of additional information about intra-group transactions, and we want to look at them one by one. With additional information A, you can see that it is about inventory. So once you know that it is a sales of inventory, the first thing you need to look for is not any amount, is to look at the date and look at the timing, because whether it is a current year or prior year transaction is going to affect the format of the journal. With this additional information A, it says that included in the opening inventory. So when you see the term opening inventory, it means that this is a prior year transaction. If it's a prior year transaction, it means that in the last year, the group has already eliminated the amount of revenue, and you don't have to do that again. That means in this journal, the only thing you want to eliminate is the unrealized profit. So after you know that this is a prior year transaction, then the next thing to know is to look at the amount. With this one, it says that the original sale was $12,000 and the cost of that item was $9,000, which means that they got $3,000 of unrealized profit, which they transfer to the current year. And that's the amount that we want to eliminate. And the question also says that they sold everything by the end of that year. Okay, that means that it was unrealized last year, but it's going to be realized in the current year. So with the journal entry, we want to debit retained earning. We also want to debit income tax expense because we have realized that in the current year. And the amount of that, as you all know, that it was $12,000 minus $9,000. So the amount of unrealized profits was $3,000. After tax is going to be $2,100. And then $900 will be the tax effect. And we are going to credit cost of sales of $3,000. Once again, as you all know, that some of the intragroup transactions may affect the NCI adjustment later. So any intragroup transaction, if it affects either the retained earning or the profit, you need to consider, is it going to affect NCI? So with sales of inventory and also sales of machinery or any sales of asset, the important thing you need to look for is who is the seller. If the parent entity is the seller, it's not going to affect NCI. But if the subsidiary is the seller, then it is going to affect NCI. So the key is to go back to the original question and to find out who is the seller. In this additional information A, it says that subsidiary purchased the item from the parent. So in this particular sales of inventory, parent is the seller. So we'll go back here and say that it was parent sold that to subsidiary. What that means is that it's not going to affect NCI. Parents is the seller. Parents is the entity that recognized the unrealized profit. It didn't affect the subsidiary. It's not going to affect NCI. Moving on, let's look at additional information B. In this one is also a sales of inventory. But this time you can see that it's the current year. So it says it right here is current year. If it is a current year transaction, first of all, you need to eliminate the sales revenue. On top of that, you also need to eliminate the unrealized profit as well. So based on the question, it says that they sold the inventory for $20,000 and the original cost was $15,000. So $5,000 was the profit. But you also need to find out how much of this $5,000 was unrealized. It says that half of this inventory remain on hand by the end of the year. Okay, half of that. That means half of that remain unrealized. So going back to the journal, first of all, we want to eliminate sales of $20,000. After that, we need to calculate the amount of unrealized profit. So it was $20,000 minus $15,000, and then the whole thing we need to multiply by 50% because half of the inventory remain on hand. As a result, the amount of unrealized profit was $2,500. So we got a credit inventory for $2,500. And then we want to work backward to balance the journal by crediting cost of sales, $17,500. Okay, so for current year transaction, we also need to recognize the deferred tax as well. So 30% of that unrealized profit, 30% of 2,500 is 750. Or we want to credit income tax expense, 750. Once again, just like the last transaction, we need to find out whether this particular intragroup transaction is going to affect NCI. So going back to the original question, you can see that in this one, subsidiary sold the inventory to the parent. So if subsidiary sold the inventory to the parent, it means that subsidiary is the one who recognized the unrealized profit. As a result, it's going to affect NCI. Subsidiary sold to parent. So NCI need to be adjusted, and you need to identify whether it's going to affect step 2 or step 3. This particular transaction, it says that in the question is current year. So it's going to affect step 3. So for step 3, it's going to affect profit. The amount of unrealized profit was $2,500. After tax, it's going to be $1,750. Go down, $1,750. So with this intragroup transaction, later on, you need to include that in the NCI adjustment. Okay, after that, The next transaction that we need to prepare, additional information C, is about sale of machinery. Once again, every time it's about sale of asset, the first thing you're going to look for is the date. With this one, the date was 3rd of June 2010. With this one, it was prior year, and more specifically, it was 1.5 years ago. Why do we need to be specific? Because with sale of machinery, this is a depreciable asset, and we need to adjust the depreciation on a yearly basis. So you need to know exactly when was the original sale date and how far it is from that date to the current date. It's 1.5 years ago. So if this one is a prior year transaction, which means that we first need to eliminate the unrealized profit. So if this amount, it says that they sold the machinery for 80,000, and then the carry amount at the date of sale was 60,000, which means that we have an unrealized profit of $20,000. So this is our starting point. We got debit retained earning, and then also debit DTA. As you see, we have $20,000 of unrealized profit. After tax will be $14,000. 6,000 of DTA. To finish these intragroup transactions, there are two more things we need to do, because remember that with every intragroup transactions, we want to go back to the original position. Originally, the subsidiary recognized the original cost as well as the accumulated depreciation. So the next part of that is to reinstate the original cost. So based on this question, you can see that the original cost was 100,000. So from 80,000 to 100,000, we want to debit 20,000 to go back to original cost. After that, we also want to reinstate the accumulated depreciation. And the accumulated depreciation will be $40,000, from 100,000 to $60,000. That will be the unrealized profit journal. On top of that, we also want to reverse the depreciation on a yearly basis. So as you can see that in this one, the amount of unrealized profit was 20,000. And the number of years of useful life was 5 years, which means that we want to reverse $4,000 of depreciation per annum. It has been 1.5 years. Okay, 1.5 years. So we want to debit accumulated depreciation. 1.5 years would be 6,000. After that, we count backward 12 months, that will be the current year. So depreciation expense. The whole year will be 4,000. And then the remaining half a year will be prior year, which is $2,000. Okay, once again, when we reverse the depreciation, we also need to reverse the deferred tax as well. So with this one, we want to reverse retained earning, income tax expense, as well as DTA. So the retained earning will follow retained earning. 30% of that will be 600. Income tax expense will follow depreciation expense, which is 1,200. Finally, the amount of DTA will be the entire amount of depreciation, which is 1,800. Once again, before we go any further, we need to look at whether this transaction is going to affect NCI. And more specifically, you can see that we have the sale as well as the depreciation. So going back to the original question, it says that in this case, subsidiary sold the asset to the parent entity. Once again, subsidiary is the seller. If subsidiary is the seller, it means that it's going to affect NCI. In this question, it affects both the retained earning as well as the profit. So it's going to affect both step 2 and step 3. With step 2, it's going to affect retained earning. So let's take a look at the question. So if this one, we have 14,000 that came from the unrealized profit. So you're going to decrease 14,000. At the same time, you also reverse the depreciation through retained earning as well. And the amount will be $2,000 minus $600 after tax. and it's going to increase that by 1,400. As you can see that this one, we credit retained earning. So we want to increase retained earning. We want to do the same thing for profit. With profit, the only one that is going to affect profit would be depreciation expense. Once again, after tax, the amount will be 2,800. As you can see there, we credit depreciation expense, which means that it's going to increase 2,800. Okay, so that would be the end of this depreciation and machinery journal. So we have used all the additional information, but is that the end of the intra-group transactions? As I said before, you need to actively look for intra-group transactions. We already look for dividend on the statement. Why don't we look at the rest of the statement to see if there's any other information about intra-group transactions? Going back to the question, if you look at the statement, you will see that there's an item called advance from and to parents and subsidiary. This one is an intra-group loan. The reason that they don't need to give you any additional information is because this is an interest-free loan. They don't need to give you any information about the interest. As a result, they don't need any additional information. But you know that this $40,000 is also intra-group transactions, and you need a journal to reverse that. So going back to the question, we are going to debit advance from the parent, 40,000, which is a liability account, and we also want to credit the advance to the subsidiary, which is an asset account. $40,000. So make sure that you look at the entire question, including the additional information and the statements, before you move on to the next part. After the intra-group transaction, the next part is NCI allocation. So as you know that we got 3 different steps of NCI. So with step 1, it's about pre-acquisition equity. So this is not a pre-acquisition entry for parents, but this time you are doing that for NCI. And the format will be very similar. So pretty much we want to eliminate all the pre-acquisition equity. So just like the parent transaction, we're going to start with the capital. If you recall that the amount of capital was $120,000. And we want to eliminate 30% of that because NCI owns 30% of the ownership. So we want to debit capital by $36,000. After that, we need to do the same thing for retained earning. That will be $12,000. General reserve, that will be $6,000. So once again, this 3 pre-acquisition equity is very easy to calculate. But with the BCVR, you need to be a little bit more careful because the BCVR, once again, they come from a number of different assets. Remember that this is a full goodwill question, which means that you need goodwill for NCI as well as the parent company. Going back to the original question or the acquisition analysis, you can see that the amount of goodwill that you want to allocate to NCI was 3,600, and we're going to include that in the calculation here. So goodwill, 3,600. So that's the goodwill. And then we got machinery, 7,000, 30%. And finally, we also got land, 21,000, 30%. So that's land. So if you include everything together, you will find out that the amount of BCVR that we want to eliminate equals to $12,000. The main difference between step 1 NCI and also pre-acquisition entry is that for pre-acquisition entry, we want to credit investment. But with NCI step 1, we want to credit NCI. And when you include NCI in any NCI journal, pretty much this is a balancing journal. So what we want to do is to add up all the debit in this case, and the total will become the amounts that we want to put that on the credit side. So in this case, it will be 66,000. So that will be step 1. And then with step 2, With step 2, before you start, you might want to think about what do we need to include in the step 2 NCI allocation. The main item obviously will be retained earning. So that will be the major item. But on top of that, you also need to consider reserve as well. And reserve include BCVR as well as general reserve. So we're going to start with the retained earning. With retained earning, we need to look for the change of retained earning from the acquisition date to the beginning of the current year. So how do we look for those information? So based on the statements, you can see that the amount of retained earning at the beginning of the current year was $60,000. And at acquisition date, the amount is $40,000, which means that from acquisition date to the beginning of the current year, the amount of retained earning increased by $20,000. That $20,000 would be the starting point of our step 2 calculation. So we're going to write down opening retained earning. $60,000. And we want to minus pre-acquisition retained earning. And the amount was $40,000. So our starting point will be $20,000. So with this $20,000 starting point, we then need to consider, have we made any adjustment based on any journals that we recorded before? This is the time where your working become very useful. So pretty much we're going to go back to first the BCVR entry. With the BCVR entry, you can see that we want to decrease retained earning by $2,800. And the reason is because we want to adjust the depreciation of machinery. So that will be the first adjustment. After that, go to the next page. You can see that with this one, this is about profit, not retained earning. So we can move on. We got nothing here. Another page. Also, this one is about profit, so it's not going to affect retained earning. Then for this one, you can see that we have another one. This time we have two adjustments. Also about machinery, but this time it came from intra-group transaction. So one is unrealized profit, and the other one will be about the reversal of depreciation. So we have 3 adjustments in total in terms of retained earning. And we want to write that down one by one in our working. So first of all, we want to minus depreciation of machinery. That comes from BCVR entry. Or you can write down fair value adjustment. With this one, we want to decrease that by $2,800. So that's the first adjustment. The next one, we got the unrealized profit from the sale of machinery in the prior year. So we can just write down sale of machinery. And the amount was $14,000. Finally, we want to add back depreciation of machinery. This one comes from intra-group. And this time is an increase. So if it's an increase, you don't write down any bracket. So it's $1,400. So that's the 3 adjustments that we need to include in our retained earning calculation. So the amount of adjusted retained earning that we want to allocate to NCI after the calculation equals to $4,600. So that's the amount of adjusted retained earning. And you know that NCI has 30% of the interest. So 30% of 4,600 is 1,380. So as a result, we want to prepare journal for retained earning. This one we want to increase retained earning. So we want to debit retained earning, 1,380, and we want to allocate this retained earning to NCI, 1,380. So that will be the journal. Very importantly, for step 2 retained earning and also step 3 profit, you write down working for both the description as well as the accounting numbers. Because if you have any consequential errors, then we are able to identify them. So as I said, apart from retained earning, we also need to look for reserve as well, including BCVR as well as general reserve. So first of all, let's look at BCVR. You can see that we do have one journal entry that we prepared for BCVR before. However, we already stated clear that it is step 3 because that happened in the current year. And nothing happened in the prior year about BCVR, so we don't need any journal. How about journal reserve then? Journal reserve, we also identified that there was no change in journal reserve from the acquisition date to the end of this current year. It's still 20,000, there's no change, which means that in this one, we don't need any journal for journal reserve as well. It means that that's the end of step 2, we don't need any additional journal. Then we go to step 3, NCI step 3. Once again, before we start, we want to write down the accounts that we want to adjust. For this one, we have profit, we got reserve, as well as dividend. Those are the 3 possibilities. Okay, once again, we're going to deal with the difficult one first. Let's look at profit. With profit, the starting point is more straightforward than retained earning because all we need to do is to go back to the question and find out what is the after-tax profit for the subsidiary, which in this case you can see that is $72,000. So that will be the starting point. So we're going to write down profit, 72,000. So that will be a starting point. After that, once again, we need to look for adjustments arising from BCVR entry as well as intra-group transactions. Let's start with BCVR. With BCVR, the first one that we can see, we have a decrease of profit, 1,400, that came from BCVR, depreciation of machinery, that will be the first one. Second one, we have NCI step 3. Here we also decrease profit. That one comes from gain on sale of land. So that one we also need to include that. So that will be the second one. The third one is here. We got sale of inventory in the current year, coming from intra-group transaction. Finally, we have one extra one. Also come from intra-group transactions. This one is depreciation of machinery. So we need to include this one as well. So we have 4 adjustments we need to include in our calculation. So the first one, we want to minus depreciation of machinery. So that one comes from BCVR. The amount was 1,400 decrease. So that will be the first one. Second one, we want to minus the gain on sale. It was land. With this one, there will be 21,000. The third one came from sale of inventory in the current year, and the amount was 1,750. Finally, we want to add back the depreciation of machinery, and this one comes from intra-group. And the amount will be 2,800. So that's the 4 adjustments that we want to include in our calculation of profit. So the amount of adjusted profit equals to 50,650. Once again, NCI will get 30% of that. And the amount is 15,195. So that's the amounts that we want to include in our journal. So with the journal entry, we want to debit NCI share of profit and then credit NCI. So that will be the first part. After that, we also got journal for reserve as well as dividends. We will look at the dividend first because it's easier. So with the dividend, going back to the original question, you can see that we got 2 amounts of dividend there. 70% of that dividend we already eliminate through the parent intra-group transactions. So the remaining 30% we want to reverse through the NCI step 3. So with the dividend journal, remember dividend come from retained earning. So when a company pays dividends, the amount of equity will decrease. As a result, with our NCI journal, we want to debit NCI. And the amount will be 5,000, 30% of that. So that will be 1,500. And we want to credit dividend pay. And we're going to do the same thing for declare as well. 18,000, 30%, and the amount will be 5,400. And we want to credit dividend declare 5,400. So we've got an NCI journal for dividend. So finally, we need to look for reserve. As we discussed in step 2, there's no change in general reserve. So there's no journal for about general reserve. But we need to look for whether there's any journal for BCVR, which we already got information from before. As you can see that right there, we got this BCVR, and we also say that it's debt-free because it occurred in the current year. So that one was about land. We also did the calculation as well, which is 6,300. So what we need to do here is to write exactly the same journal as parents, but we want to put that under debt-free NCI and with a different amount. So with this one, we want to debit transfer from BCVR 6,300 and then credit BCVR 6,300. So we have prepared journals for profit, dividends, as well as reserve for debt-free NCI. And that's the end of the question.